Howdy there, private group members. Hope you guys are doing great as always out there. I want to do a little lesson on what I call a medium-term price theory, essentially. And when I talk about medium-term price theory, essentially what I'm talking about is what happens with the stock price over a 1 to 2 year span. So that's what I'm really referring to as medium-term, right? Anything less than 1 year is really like short term. If you start talking about over a couple months, that's like super, super short term. If we start talking about, 3 years out, 4 years out, 5 years out, to me, that's long term, right? So when we're talking about medium term, we're usually talking about a 12 to 24 month span, could even be a 6 to 18 month span, somewhere in there roughly, when we're talking about medium term price theory. And so essentially, I think there's some important things to understand because investors, a lot of times they get frustrated if a stock price is going down after they invest in it, right? And I think there's a few reasons why you shouldn't actually be against this, and actually you should be for this. And so first thing, obviously, I want to cover the most obvious point of this right off the top, and then we'll get into a few other things that people don't really think about. The most obvious one, right, is if a stock price is down for 6, 12, 18 months, 24 months, you get to acquire more and more shares of that company, right? Because no one, unless you know nothing about stock market investing, no one goes all in a stock in a day. It's like, oh, I see the stock, I researched it last night, I'm all in. Like, no one does that who knows anything about stock market investing. The only market that works in is if you're in a hyper bullish market that literally just, every single dip gets bought up like in a snap of fingers, right? So, which would kind of almost be the 2020 stock market after we got through the March 2020 crash, right? Now, most markets you're in are not going to be like that. Most stock markets you're in are going to be just kind of like, up and down, but mostly up. That's going to be the stock market most of the time. Every once in a while, you're going to be in a tanking market where everything's just crashing. Every once in a while, you're going to be in a flatlining market, but the majority of time, you're going to be in a market that just trends up. So you're never incentivized to go all in one day or something like that, right? So the most obvious reason why you should want a stock price to be down for a 1 to 2 year span after your initial buy-in is so you can acquire shares, more and more shares over an extended period of time, and hopefully build out a really, really nice size position in that stock over time, right? Now, let's get into a couple more things that are not so obvious on why this is very, very important. So think about it from this context. If, I pulled up Corsair here. I want to use this as an example. Let's say I looked into Corsair gaming and I like what I saw. So I start my little position in it. Usually I start a small position in it and I build a position over a course of 6 months, 3 months, 9 months, depending on the stock, maybe 12 months. So let's say I start my position in Corsair, right? Well, let's say I started my position in Corsair at 19. And then right away, it goes up to 23. I haven't really built my position out. There's a high probability that I would have ended up probably cashing in this scenario because I just come across a company. I just started researching it. I like what I see. I think it's a pretty fair price. So I start buying in. Right away, it goes up. There's a good probability I end up cashing shares, right? And that's happened to me on many, many stocks before where I didn't get my initial position really built out the way I wanted to get it built out. And next thing you know, I end up cashing my shares pretty shortly after because I was like, I didn't even get my position built. It's already gone up. That's some other stock I like. I'll just get out of this, right? Now, on the flip side, if you have a stock that downtrends for 3, 6, 9, 12 months, and I liked it at ... price, I'm going to buy more and more shares. Now, the thing with this is over time, is I'm going to end up building ultra conviction in this stock, right? Now, all stocks can trade at different PE metrics, price to sales metrics. There's no perfect numbers. But what I can tell you is when you have a shareholder base that buys in over a longer period of time, these people are really, really sold in on that company, and they're really in that for the long term. Otherwise, they would have already gotten out, right? Weak hands already get out. If you have somebody that's, let's say, putting stop losses on their stock or things like that, like those people get out. But if you have somebody like myself, right, which you could be me, it could be a hedge fund manager, whoever, right, where they're buying into a stock, acquiring more and more shares of that as it drops over a 6, 12, 18-month span, we're going to have ultra conviction in that stock. And if that stock goes up in the short term afterward, we're not selling it. We're likely, that stock would probably have to double, triple, quadruple up before we even consider selling it, right? And so you can end up going on some epic runs where folks just aren't even considering selling that stock because they've built that ultra conviction over a 6, 12, 18, 24 month span. And so as things start to play out, they're like, I knew this was going to play out. I'm not cashing out of my shares in that situation, right? So you build a much better shareholder base who's really in that for the long term, a much better shareholder base. Okay, that's next. Next thing up here is think about it from the perspective of if you have a downtrending stock price. Well, shoot, you know what you're going to end up having? You're going to have an ultra motivated CEO of that company, and likely the entire executive team. CEOs try not to look at the stock price too often, but believe me, they see it. And if a stock price is going down over a 6, 12, 24 month span, believe me, they're going to be fully aware of that. They're going to have to hear from shareholders. They're going to have to hear from the board of directors. They're going to probably keep an eye on that. A lot of compensation can be share-based compensation. And if a stock price does good over time, many times executives can get big, nice payouts if the stock price trends up. And sometimes they even have equity awards based upon how much shares go up. So the bottom line is if you're a CEO and you have a downtrending stock price or stock price not going anywhere, you could end up being out of a job. So you're going to be ultra motivated to work your tail off every way possible and get the most out of your employee force, the most out of your company, and try to pitch the vision as well as possible to investors, right? Because you understand that if you don't get that stock price moving in the right direction, you're likely going to end up being out as CEO. You're likely going to make way less money. The CEOs that make the most money are the ones that have, stock prices that perform over time. And, what they can make off that in the stock options is amazing. And so, I think that's another factor a lot of people don't think about. And believe me, it drives executives big time. Now, next reason why you should not be scared of a stock price that goes down over a 1 to 2 year span is essentially you get into this environment with a stock where if anybody is, the weak hands, as they call them, right, they get shaken out during this time period. And so what you end up starting to see is very low volume, and you start having trouble finding sellers for a particular stock. And there's certain stocks that we can see this happening in where they'll move up on low volume. You can't find really sellers in some of these particular stocks, right? And there's just really no big time selling pressure out there. And so what ends up happening is you just get all these folks shaken out, and you end up building this kind of shareholder base that is just relentless in buying. And, the folks that are in for the short term, they're already out. You're not attracting a lot of traders to those sorts of stocks because traders look at that and they're like, it's a dead stock. It's not doing anything. Why do I want to trade this stock? There's not much going on there. And so you just kind of slowly, you just end up wiping out that entire thing. If the stock price doesn't go anywhere or downtrends for a year or two, believe me, traders don't really want to play that. They want to play volatility. They want to play stocks that are mostly going up and going up huge or going down huge. That can be the scenario, right? But they want to play volatility for the most part. And if you got, not that much volatility, it's not that interesting to them at the end of the day, right? The last point I want to make here is think about it from this context. You invest in a company. What is the progress that's made in that company over that given span? And why does that matter so much? So, if I'll use TTCF as an example here. I started buying the stock, 9, 12 months ago or whatever, right? If I look at what's going on with the underlying business, the future, all those things, it's a lot more exciting than when I first started buying in the stock. And the stock's a lot lower than when I first started buying in that stock. So for me, somebody as a long-term investor, that's very, very exciting because I'm looking at this and I'm like, okay, the story's a lot better. The fundamentals are a lot better than I thought they were going to be. They're going after a lot more things a lot faster than I thought they were going to go after. Everything's, executing at a more rapid clip than I thought it would, right? And so I start to think about it in context of, wait, the stock's much cheaper than when I first started buying in, which I liked when I first started buying in, but the fundamentals have gotten a lot better. That's one of those things that gives me ultra conviction. And that's why when some of these stocks start making moves, I'm like, I'm not even thinking about cashing on those. I'm like, I'll let those babies run for a long time in the future. And that's exactly what I did with Tesla. Like, for me to start, it was, at least 2-3 years after, until I started even considering cashing any Tesla shares. That stock was up hundreds, if not 1,000+% before I was like, okay, let me start cashing out some shares. And if you look at the public count, I didn't start cashing out some shares until, the past, 3-4 months, when I've already gotten like a, 2,000% gain on that stock or whatever. Because at the end of the day, when it comes to these stocks, I'm like, I'll let them go on their runs. I'm not in a rush to jump out of that stock. Yeah, I have to see something better out there, right? But I've run out of it. You can let it run for 2, 3, 4 years, 5 years, or if you really want to hold it for 10, 15, 20 years, that's fine as well. For me, usually there's something else I'm going to find that's going to be more appetizing to me. So I'm likely going to end up moving my money out, right? I don't usually think about stocks in terms of like, I'm going to hold the stock for the next 10, 15, 20 years. Not that that's a bad idea at all. I'm usually just thinking about the next 3 to 5 years and what I see for that company over the next 3-5 years. Because after 5 years, I have trouble usually trying to see the future past 5 years. That gets difficult. There's so much changing all the time with companies, and I think things are changing faster than ever that it gets tough to even forecast what a company is going to be doing, 10 years from now. For instance, if I was thinking about like Apple stock, and let's say I was thinking about that as an investment, I don't even know if people are going to have iPhones in 10 years. Like legit, I don't know. Like it's very possible we don't even have iPhones anymore. Or like we don't have cell phones at all. Maybe we're in the metaverse and we have some device that connects. Enjoyed this kind of talking about a little medium-term price theory and why you should usually be happy if you buy into a stock and it goes down over a 1 to 2 year span, because there's a lot of benefits that end up coming with that. So anyways, much love as always, and have a great day.